Okay, so today we're going to look at taxation of companies and property transfer tax. So taxation of companies is similar to the way you calculate the taxation for a sole trader or a partnership. They're virtually the same. They're just minor differences, but the idea is the same. But property transfer tax, oh my goodness, these are free marks.
Okay.
Yeah, property transfer tax are just free marks. If they come, then you'll be able to have my good free marks. So let's begin with company taxation of company income. So now, so company income, which companies or rather which entities are liable to taxation? So those that are liable to taxation in Zambia are those companies which are resident in Zambia. And companies which are resident in Zambia are those which are incorporated in Zambia. Then their effective management is undertaken here in Zambia. So it's incorporated in Zambia. You've registered at Pakra. Then the effective management is here. The head office is managed right here in Zambia. So those two companies, those are liable to company tax. So now let's learn how to calculate taxable income. So, the first point is non-deductible expenses are added back to net profit. Just like the way we do it for a sole trader and a partnership, non-deductible expenses are added back to the net profit. Then non-taxable income is also added back to the adjusted profit. Right? So did I say that? Oh, non taxable income is deducted, actually. It's deducted from the adjusted profit. So
Profit.
non-deductible expenses are added back. Then non-taxable incomes are deducted. Then capital allowances are also deducted from the tax adjusted profit. Then also look at the incomes for a company. So the company's income, we've got the business profit, the day by day profit that the company earns. Then there's the rental income. If that particular entity has got an investment property, they've listed out, or maybe they've just put someone to rent it for a certain period of time, that is rental income. It's also calculated as income for the company. Then royalties, the company has got a patent or it has got a trademark, then another company is using that particular patent or trademark, then they're receiving royalties, that is also calculated as income. Then interest received, interest on treasury bills, government bonds, also interest on bank interest deposit, deposit interest, you know. Then also dividends, where a company has got stake in another entity. For instance, it has got shares on a company that's listed on the stock exchange, then they receive dividends on a consistent basis. That's also calculated as income for tax purposes. So now, how do we compute tax? So first of all, you need to get the business profit, and this business profit, this is the tax adjusted business profit. So number one, you need to obviously calculate the capital allowances as appropriate and as relevant. Then after that, you need to calculate the taxable profit. The non-deductible expenses, those expenses which are not deducted for tax purposes, that are added back to the net profit. Then the non-taxable income is deducted, as well as the capital allowances are deducted. Then you're going to get the taxable profit, and the taxable profit is the one that we put here on business profit, right? Is the one that we put here on business profit. So
Business profit.
business profit, that's the tax adjusted profit. Then interest income, for instance, a company has got investments in government bonds and they're receiving a coupon. When they receive that particular coupon, it's added back to the net or rather the business adjusted profit, and it's supposed to be at gross. Then royalties as well, they're added back, they're supposed to be at gross. Then you're going to have the total income, then you less deductible incomes, those incomes that are deductible, you deduct them, then you're going to have the taxable profit. Then after you have the taxable profit, then you need to charge 30%. Uh, I don't know if it's 30% now, but we have to check the taxation paper. That's where we're going to find it if the tax rate is 30%. But for now, we're going to work with this 30%. So you charge 30% to taxable profit, and you're going to have the income tax. Then that income tax, you need to deduct tax already paid. So tax already paid, this is you deduct withholding tax from interest income, withholding tax from royalties, then you also deduct the provisional tax already paid. Then the balance here is what's going to be the income tax payable. So this doesn't really make as much sense when I'm explaining like this, but if you practice, you're going to discover that it's just porridge. It's easy peasy. I don't know if you have any questions so far.
No questions.
No questions, right?
Yeah.
Okay.
This is the format, right? This is just the format.
Yeah, this is just a format. Yeah, it's a format that
Uh,
you use for company income tax. Okay, so now the rates of income tax. So, so for profit on manufacturing and other companies, it's 30%. Then income from farming. So whether it's a sole trader, it's a partnership, or it's a company, the tax rate on farming income is always 10%. So that 10% doesn't change. So the 10% is consistent uh, regardless of the type of entity you're working with, right? So companies which list their shares on the Lusaka Stock Exchange are given a 2% tax discount. So in that particular year, when the company is listed, the tax discount is 2%, right? So if they're supposed to pay 30%, then they list their shares on the stock exchange. As an incentive, ZRA gives 2% discount. So they're supposed to pay 28%. That's only in the first year of listing. That's all, right? Then a further 5% discount is given if 1/3 of the shares are issued to indigenous Zambians. So if 1/3 of the shares are issued to indigenous Zambians, a further 5% is given. So you've got 2% plus 5%, less from 30%. It means that particular company is going to pay 23% tax, provided it lists its shares on the stock exchange, which is 2%, then it issues the shares, 1/3 of it, to indigenous Zambians, people like me and you, right?
yeah.
Now, how do we calculate taxable profit? This is just revision. So taxable profits, you've got the profit before taxation, or sometimes it's the net profit, but for the companies, profit before taxation, right? You get the profit before tax, then you add non-deductible expenses, then you add taxable income not credited to the accounts. So you have to be alert when you're looking at the adjustments. The taxable income
Oh,
not credited to the accounts, you add it back. Then you're going to have the total here. Then you deduct non-taxable income, which is obviously yeah, profit on disposal of non-current assets. Then you also have incomes that are subject to withholding tax. We've got the royalties, we've got the rental income, we've got the interest, we've got all these other incomes that are subjected to withholding tax. You add them back. Then you also deduct the capital allowances. So the capital allowances plus non-taxable income, then you deduct it from the tax adjusted business profit. Then when you deduct that, that's going to be the taxable profit. So this taxable profit is the one that we bring here on business profit.
Profit.
Yeah. Okay. So now deductible and non-deductible expenses. So now the idea with company income is just the same with that of sole trader and partnerships, right? But there's only a slight difference, right? So expenses incurred for business purposes and personal use are not apportioned. So if you remember in a sole trader, when a sole trader is using the asset for personal errands as well as the business purposes, we're going to restrict capital allowance claimable to the amount of business use, right? But for a company, whether it's being used for personal errands or for business errands, the total amount of capital allowances is supposed to be deducted, right? An allowance of 2,000 is given to a company which employs differently abled persons. The following must be satisfied. So where a company has employed somebody who's differently abled, right? An allowance of
Yeah.
2,000 kwacha is given, but there are certain conditions that need to be met. So one, that person must be employed on full-time basis. So the differently abled person is supposed to be employed on a full-time basis. The period which must be covered, that employee who is differently abled must be employed for the period of at least 274 days. So that's a substantial period which ZRA recognizes. So that person that who's differently abled is supposed to be employed for at least 274 days, then they can claim this 2,000. Then if the person dies within the charge year, the charge year is basically the accounting year for tax purposes, right? The period is reduced to between 184 days to 274 days, right? So this is about the differently abled persons. So if a differently abled person is employed by the company, a capital allowance, or rather an allowance of 2,000 is given to that particular company, provided they meet the relevant criteria. Then, if a director is provided with free accommodation, right? They're given a house that the director is supposed to stay in as part of the perks and benefits of employment, right? A 30% charge on the director's salary is added back to the net profit. So this is the annual salary. What's the director's annual salary? Then you charge 30%. After you charge that 30%, you add it back like it's a non-deductible expense. So you also have to be alert when they talk about salary, a salary of maybe a finance director, a salary of a managing director, a salary of marketing director, then you have to know saying, okay, a 30% accommodation charge of that particular annual income is supposed to be added back to the net profit, right? So now, in an instance where a personal to hold a vehicle is given to an employee or director, right, a fixed amount must be added back to the net profit. So it depends on the cylinder capacity of the particular car that's been given to that particular employee or director. So if they're given a car which has a cylinder capacity less than 1,800 cc, a fixed amount of 18,000 per annum is supposed to be added back to the net profit, right? Then if the cylinder capacity is between 1,800 cc to 2,800 cc, then a total of 30,000 per annum is supposed to be given, right? So you add back 30,000. Then this, if the car has a cylinder capacity of more than 2,800, then the amount that's supposed to be added back to the net profit is 40,000 per annum. So these are quite important. Sometimes you're going to observe saying, oh, there's a car, personal to hold a vehicle given to a director. It has got a cylinder capacity of maybe 3,000 cc. Now it will be up to you to remember because you're not given this information. You need to remember saying, oh, this car is more than 2,800 cc. So the amount that's supposed to be added back as a fixed charge is 40,000. If it's below 1,800 cc, 18,000. Between 1,800 and 2,800 cc, 30,000 per annum, right? Now, there,
Yes.
there are also some times where the company's got a pool car. What is a pool car? So a pool car is basically a car which is used by different individuals. It's not allocated to a particular person. No, this is your car, you should be using it. So it's just a car which is for everybody in the company. I'll give you a typical example as a commercial break. There are those girls, you know, that are everybody's girlfriend, you know,
Yeah.
anybody, so long as, I don't know if you've got story, but so long as you can be able to make your move, she's
Okay.
just
As long as you just have money.
yes, there are those types of girls. So those are pool girls.
Yeah.
They're everybody's girl. So now that's the same analogy for a puka. So a puka is basically a car that's used by different individuals who are authorized, obviously, in the organization. Then that car does not spend a night at the premises or near the premises of a director or an employee. So it stays in the company. It doesn't go home. It's not taken home. It stays in the premises of the company. Then it's specifically meant for business use. So sometimes personal to order vehicles, you're given a Benz by a company. You can be using it to go and take your children to school, right?
Yes.
You can even, you're going on a, you go on a date with your wife, you can go with the personal to order vehicle. It's personal to order, but for a puka, it's specifically for business purposes.
Yeah.
Yeah. So now deductible and non-deductible expenses continues with dividends paid and non-deductible for tax expenses, for tax purposes rather, and dividends received and non-taxable income. So whenever a company issues dividends, these are non-taxable, or rather they're non-deductible. So they're supposed to be added back to the net profit. Then if they receive dividends, dividends are non-taxable. It means they're supposed to be deducted from the tax adjusted profit. So now companies borrow money in order to finance their different projects. So now they pay annual interest. So now, when annual interest is paid, according to ZiCA, that interest is limited to only 30% of the earnings before interest, tax, depreciation, and amortization. So the only amount that's deductible, that's allowed by ZiCA, is 30% of the earnings before interest, tax, and depreciation and amortization. So now, if you've got interest which exceeds 30% of the earnings before interest, tax, depreciation, and amortization, then the excess of the 30% is supposed to be added back to the net profit. Then, if a loss is incurred, if the earnings before interest, tax, depreciation, and amortization is a loss, then the whole amount of the interest is supposed to be added back. But now, when this interest is added back, it needs to be carried forward to the following year for 5 years. But that interest should not exceed the earnings before interest, tax, as well as depreciation. So it can be carried on forward for at least 5 years. So this is just something that you need to know in case you've got interest which is exorbitantly high. So you need to test the interest. You have to check, is the interest more than 30% or is it less, right? So just make sure when you observe saying, oh, the interest on the debt was such and such a thousand, then you need to test, you know, multiply 30,000 by earnings before interest, tax, and amortization. Then you compare with the actual amount of the tax. Then you see if it's more than, then you have to restrict the amount deductible to 30%. Then the excess is added back. Any questions?
No questions.
Okay, so capital allowances are also given to a company. So capital allowances are given on implement plant equipment, rather implement plant and equipment, same as for a sole trader in the partnership. So everything is just the same. There's no difference. So the capital allowance that you lent is the same capital allowance that's applied here. Now on buildings, it's also the same. For industrial building, 5% wear and tear allowance, then 10% initial allowance in the first year of use, then 10% investment allowance when the building is constructed by the particular company. Then for low cost housing, these staff canteens and all these other low cost housing, the cost is limited to 100,000. So I remember this is something I wanted to tell you, but I'm glad I've come across it. So I told you about the low cost housing when we're looking at capital allowances, saying it's restricted to 20,000. I checked uh, the updated figures. It's actually limited to 100,000. So the low cost housing should not exceed 100,000. So this is the latest figure. It's 100,000, not 20,000. So you need to update your information. It's supposed to be 100,000 and not 20,000. So if you check the question paper, you're going to check saying the low cost housing or staff canteen is limited to 100,000. Then for commercial building, the capital allowance is 2% on the cost. Then disposal gives a rise to a balance in charge or balance in allowance. So these things are just the same consistently with how we lent them when we were looking at capital allowances. So now let's look at investment income, right? So investment income, which is not final tax. So this is very important. So when an income is not final tax, we add it to the taxable income, right? We add it to taxable income at gross. After we add it back, and then we charge tax. And when we charge tax, we need to deduct the interest that's already paid, right? The 15% withholding tax is supposed to be deducted. So after we add it back, then later on, when we're calculating the tax, we need to deduct it from the amount of taxation which is payable, so that we arrive at the actual amount which is payable. So the following investment incomes are not the final tax, right? They're not the final tax. So these are supposed to be added back. Then the withholding tax is supposed to be deducted from the tax. So we've got bank interest. So if a company has got money in a deposit account and they're receiving back interest, that amount is not the final tax. Then building society interest as well, then treasury bills as well, then GRZ bonds interest and royalties. These are not the final tax. You have to add them back. So wherever you see bank interest, building society interest, treasury bills interest, government bonds interest, and royalties, they're supposed to be added back at gross. Then the withholding tax of 15%, which has been paid, is supposed to be deducted when you're calculating tax before you deduct the provisional tax. So interest is charged at cost and so must be deducted gross from the tax adjusted net profit. So this is just the same point I've been I've touched on. Then investment income, which is final tax and requires no further tax assessment. So rental income, dividends from a local company, public, private, as well as mining companies. Withholding tax is 15%, but it's the final tax. So these rental income, dividends from a local company and private company, you don't add them back. You just forget about them. So if you see such incomes, you just forget about them. You only deduct them from the um, calculating of taxable profit, right? When you're calculating taxable profit, where you deduct the non-taxable incomes, this is where you deduct these uh, rental income, dividend income, as well as dividends from private, public, and mining companies. But when we reach the section where, let me go back a bit. When we reach this section here, yes, when we reach this section here, so these incomes I'm talking about, they're the ones you're supposed to add here, right? Here and here.
Okay.
You're getting it?
Yes.
So those incomes I'm talking about, those investment incomes, which is not the final tax, the interest on deposits in the bank, the interest on business society deposits, the interest on treasury bills, the interest on government bonds, the royalties that are received. This is where you add them back at gross. And then here, this is where you deduct the 15% withholding tax. So here it's gross. You add it at gross, these two. Then here you deduct the withholding tax which was paid. You're following, huh?
Yes.
Any questions so far?
No questions.
Okay. So now let me go back. So this is investment income, right? Yeah. So this is basically what I was explaining. Then now we're done with company income tax. Let's look at property transfer tax. I'll tell you, Mr. Isaac, and I'm not trying to make you have a laissez-faire attitude, but property transfer tax are free marks. So
Okay.
when the examiner brings property transfer tax, which is about, so sometimes they'll give you 5 property transfer tax problems, each having 2 marks. I'm telling you that you just look at it, you'll be like, 10 marks are mine. Because it's very easy and straightforward, provided you follow
Mm,
the principles. So now,
okay.
what is property transfer tax? Property transfer tax is tax which is paid on immovable property, which is charged. Oh, sorry, let me start off again. Property transfer tax is paid on immovable property when there is change in ownership. So the keyword here, please, immovable. So all those properties that are immovable, that can be moved from one point to another. This is where property transfer tax is charged when there is a change in ownership. So these are the keywords: immovable and change in ownership. So shuttles are tangible movable properties, and property transfer tax is not charged on them. So a shuttle, for example, a car is property. We can say it's property for
Yes.
tax purposes, right? But
Yes.
it's movable. But here, property transfer tax is charged on immovable property. So anything relating to a car, anything that's movable, property transfer tax is not charged. So in an example, you come across saying, this particular company sold a car at maybe 10,000. When you just see car, you should tell the examiner this is a shuttle, it's a movable property, so property transfer tax is not charged on it. Right? So now, what are the categories of property transfer tax? We've got land in Zambia. So any land. So if there's a transfer in land on the building that is on that particular land, then we can charge property transfer tax. Any building, any structure, or any improvements there, property transfer tax is charged. Then shares as well. Shares, property transfer tax is also charged. Then mining rights and interest in mining rights, tax is also charged. Then intellectual property, there's a transfer of intellectual property from one hand to the other, trademarks, patents, and brands. intellectual property is also charged. So the keyword is immovable property and also change in ownership. Then the other important thing is chateaus, no tax is charged. Chateau is a movable property and no property transfer tax is charged, even though it has changed ownership. Then the categories of property transfer tax is land, buildings, shares, mining rights, as well as intellectual property. Then transfers of property. So a transfer occurs when there's a change in ownership. So when ownership changes, then property has been transferred. So example, disposal of property. When we sell off property, then it means there's a change in ownership, then property transfer tax is charged. Then there's disposal or part of a property. So you've got a property, then you're selling off part of it. The property transfer tax is also charged. Then also part of shareholding, you've got maybe 1,000 shares in a particular company. You sell off 200. Property transfer tax is charged on those 200 shares that have been sold. Then gift from one party to another. So where a gift is given, maybe a company gives you a gift of a house for being a loyal employee, then property transfer tax is going to be charged. Then the other issue that you need to understand, the person that's transferring the property is the individual that pays the property transfer tax, not you who's receiving. You, when you're receiving that particular property, you don't have to pay tax, but the person that's transferring the property is the one that pays the property transfer tax. Any questions?
No questions.
Okay, so this is another important aspect of property transfer tax, the residue, oh, sorry, the realized value. The realized value. So, what is the realized value? The realized value is the amount on which property transfer tax is charged. It is the price at which property could have been sold on the open market at the date of transfer. All right. So, the realized value is basically the amount at which an asset or that property that's being transferred could have been sold had it been an arm's length deal. You know, had it been an arm's length deal, the amount at which it could have been sold, that's the realized value. So property transfer tax, let me emphasize, is charged on the residue value. So you need to identify which one is the residue value. When you identify the residue value, then you charge the property transfer tax. So now, if you recognize the wrong the wrong realized value, you even charge property transfer tax on that amount, it's wrong. Then you have failed to get the simple 2 marks. So what's most important, even though property transfer tax is easy, is recognizing which one is the realized value. And the realized value is the price at which an asset which was transferred could have been sold on the open market. So the general rules, and these are very important rules. These are very, very, very important rules. Please pay attention to these rules because these are the foundation of property transfer tax. If you get them, then you'll be able to hammer very good marks. So now, property. So for property, land, buildings, and all other similar items. The realized value is the higher of the agreed price between the transferor and the transferee and the open market value. The higher of simply means one which is higher between these two. The agreed price between the transferor and the transferee and the open market value. So the higher of the two is the one that we realize or recognize as the realized value. And the property transfer tax rate is charged on that particular amount. Then for shares, the realized value is the higher of the open market value of the shares and the nominal value of the shares. So nominal value of the shares is basically the par value or the book value of the shares. So the higher of the open market value of the shares and the nominal value of those shares. So whichever is higher between these two is the amount at which property transfer tax rate is charged. For mineral royalties or interest in mineral rights, the higher of the actual price on the date of transfer. The actual price that the mineral rights are being transferred, that's the realized value, provided it's higher than the value as determined by the Commissioner General. So the amount that the Commissioner General determines. So this simply means the amount that ZRA determines, right? The higher
Yeah.
of the actual price at the date of transfer and the value as determined by the Commissioner General. I don't know if you've got any questions.
No questions.
Okay, so now conditions which result in a new realized value. So this is also important, right? When property is transferred to an immediate family member, the realized value is new. Property transfer tax is not payable. So if you transfer money, or rather you transfer a building, you transfer land, you transfer shares to your spouse, your blood child, your duly adopted child, and your stepchild, the realized value is zero. So it means you don't pay any property transfer tax. So if you see in a question saying ABCD transferred uh, land at an amount of 30,000 to the son for passing the grade 12, when you just see that, you know saying that's a condition or a transaction which results in a new realized value and the property transfer tax is not paid. But if you see an instance where no, Mr. A gifted his girlfriend a house, then that has got a realized value of that particular amount according to how it's going to be agreed. So when property is transferred to an immediate family member, there's no realized value. Hence, no property transfer tax is paid. So, the immediate family members are the spouse, the blood child, the duly adopted child, the stepchild. Then, when a holding company transfers property from one subsidiary to another for the purpose of restructuring, the realized value is nil. So, when a holding company is transferring property from one subsidiary to another, the realized value is new. So these are important points that you need to look out for as you are tackling the papers. Then we've got certain
Oh,
exempt organizations. So
yeah.
one, the government doesn't pay property transfer tax. So if property is moved, is transferred from the Ministry of Health to the Ministry of Education, no property transfer tax is paid. If a foreign government also transfers property, maybe an embassy transferred property from itself to maybe the Catholic Church, there's no property transfer tax that's charged. Then international organizations, foundations, and agencies approved by the Ministry of Finance, no property transfer tax is charged. Then registered charitable organization and trusts, no property transfer is taxed. Then any cooperative societies, local authorities, a council, if council transfers property from itself to maybe the Ministry of Lands, no property transfer is charged. Then registered trade unions, clubs, societies, and registered associations, approved pension funds or medical aid, approved employees savings scheme. If NAPSA transfers property from itself to maybe Zanaco, there's no property transfer tax which is charged. Then registered political parties, PF sales, land or maybe a building, if they sell their secretariat to UCA, there's no property transfer tax which is charged. Then Millennium Challenge account. So these are just a few information that you need to know, so that at least if you get exposed to a question, you can be able to respond with confidence. Then lastly, exempt transactions. So the transfer of shares for a company listed on a Lusaka Stock Exchange. Listed companies, when they transfer property, there's no property transfer tax which is paid. So a company like Zanago, which is listed, a company like Zambif, and the newly dead Invest Trust Bank, if they transfer property, no property transfer tax is charged. Then contributions to equity of a company. So if shareholders, existing shareholders, they provide further finance to the company, then they're given more shares in a particular entity. There's no property transfer tax which is paid. Then transfer of property as a result of the death of the legal owner. You own shares in Zanaco Bank, you demise, God forbid, then you transfer shares to somebody, maybe your wife, no property transfer tax is charged. With that said, our lesson has come to an end.
Okay.
Yeah. Any questions, clarifications, or additions?
On taxes, no questions.
Okay. So yeah, we're done for today.